And Wiley and Jeremiah Bates, the weekend's smartest money show. Investing, taxes, legal topics, insurance, and every other confusing money topic made simple.
Welcome to the Real Money Pros. Happy weekend to you. We are a fiduciary-led financial program, and we're live, which means you can interact with us. Our phone lines are always open to you, the listener. So if you have questions, if you have thoughts, you have opinions on the things that we're going to bring forth during this next 2-hour live program, give us a call. Phone number is 979-59-MONEY. That is 979-596-6639. I am Jeremiah Bates. He is Nick Daniels here at your service. Lots of things to cover today. It was a busy week. We had lots of economic data, important earnings reports, and ultimately the big news that was finally released on Friday that many had speculations on where the U.S. Supreme Court was going to go in regards to President Trump's sweeping global tariffs. Now, of course, that there was a lot of thoughts that we were going to get this news sooner rather than later. And when that news broke that we might get it on Friday, I took it with a grain of salt. I was like, at least in my mind, Nick, I'm like, yeah, we've heard this story before. I don't know if we're actually going to get this news broke, but it did. And essentially, the Supreme Court struck it down, essentially said that President Trump did not have legal authority under the International Emergency Economic Powers Act, that IEEPA. He did not have the legal authority to impose those tariffs under that specific categorization. Now, what was interesting, in my opinion, was the market reaction. When we look at the news, it was early in Friday's trading session when that news was announced. All three major U.S. indexes were in negative territory, and then they turned, which ultimately leads me to believe that the expectation across the board was, in fact, that the U.S. Supreme Court will, in fact, strike it down. So it looks like it almost met expectations of what was priced in or what was baked in, and we saw a little bit of a lift, at least on the equity side, to ultimately turn out another positive week for the equity markets.
Right, and I think Wall Street's sentiment behind that, Jeremiah, is simply that, all right, if these tariffs are getting knocked down, what it means for any sort of U.S. company that's importing, whether it's raw goods and materials, pre-finished goods and materials, or even just completely finished goods and materials that they're just putting on their shelves to selling, if it's going to cost them less to get it here, then it's going to pad their bottom line, which then, if you're a shareholder on those companies, it improves your performance on that share price. And so we saw that market rally. I think it's no surprise. It's going to create a typical Trump presidency conundrum as far as how will all this shake out. Are we going to see anyone that had to pay tariffs in 2025? Are they going to get a reimbursement now for tariffs that they paid that were apparently illegal? So there's a lot of stuff to shake out. The one thing I think about too that I don't hear a lot of people talk about, honestly, and this was even from going all the way back to April 1st, Liberation Day back in 2025. One of the reasons why it took so long, even from April through the end of the year, for so many of these different levels of tariffs between different countries to get ratified, even under this International Emergency Economic Powers Act, people forget that when Trump took office and Elon Musk was running Doge, they cut so many federal staffing positions. The Department of Trade, they don't have the staff to actually go out and do these trade negotiations like they once did.
Right.
And so that's what took so long in 2025 for so many of these deals to get done. And so anyway, I'm like, how is this going to shake out now? Now he's going to say Friday he said it's a flat 10% international tariff, and then this morning he says it's a flat 15% across the board international tariff. And the world's just like, oh man, here we go again.
Well, and I think there's two big things there. My takeaway, number one, is that what is the game plan, or what is the ruling going to be for the tariff revenue that was actually collected under that? Because if it is basically saying, no, it was illegal, like you didn't have the authority to do that, well, he did it. I mean, there was up until a point where that did in fact happen. So
Right.
is it just, okay, it is what it is, we're just going to keep things moving along and it's no longer going to be in place moving forward? Or are they going to look at, hey, we do need to have a satisfactory outcome in our eyes based on the amount of money that was collected, and what does that number look like? How do they execute it? How does it affect things for the companies that were actually affected by that? Yeah, I look at that as a short term, and then when you look at kind of more medium term, what is the response? I guess you could say this is short term, where he immediately came out and said, hey, we're just going to do sweeping 15% across the board. We'll see. Does this escalate or does this de-escalate the tit for tat response from our friends to the north, our friends to the south? The geopolitical strife that it's clearly abundant. That's a question that I have too, Mike, meaning does this kind of smooth things over a little bit? Other countries realizing, hey, like we don't have to pony up as much, just kind of smooths things, gives us some more certainty, at least on the corporate side of things, where, hey, this expectation of high tariff headwinds, now that this has been removed off of the board, hey, we can take a sigh of relief. Maybe some equity pricing was in fact based on these tariff headwinds. But you could also say that the narrative that was painted around tariffs, especially when this was implemented, that we were going to run into runaway inflation, meaning these companies are going to basically take this tariff cost, they're going to push this on to the U.S. consumer, and we are going to see inflation just go at a level that it's just going to reaccelerate. That hasn't been the case. It hasn't been. That noise that was essentially out there, it just never came into fruition. And I think that we have that time under our belt. Well, it probably, in fact, won't. Now, when you factor in this news, you could argue that, yeah, that argument or that concern largely could be taken off the table. Again, assuming what the response is by the administration, right? I mean, if they're going to try, and who knows? They might actually have that. If this was the expectation, and I would imagine that the administration probably saw the writing on the board at some point, like, yeah, probably likely that they will deem that we weren't deemed eligible to do this. They probably already have a contingency plan in their back pocket to make sure that what they promised as far as making that trade more fair, they probably have an avenue to make that happen.
Sure. I also think and wonder if this is going to be something that helps fuel like the small cap and mid cap rally that we're seeing. I mean, year to date right now, small cap stocks are up like 6.8%, the Russell 2000 index. I mean, we've been seeing small caps outperform this year, whereas the S&P 500 is essentially flat on the year. Now, what's kind of been fueling some of that turnaround as interest rates keep creeping down a little bit. Obviously that's easier on these smaller companies who are having to finance their growth and things like that. But if we see these tariffs come down from, it's hard because it was like nation by nation level, right? But if we see it come down to, say, this flat 15%, I mean, that relieves a lot of economic strain on smaller companies that don't have the cash flow to absorb it like we've seen in larger companies. We could continue to see a little outperformance in 2026.
No, I don't disagree. What are your thoughts? 979-59-MONEY. Phone lines are open. That's 979-596-6639. Do you agree with this? Do you think that the shakeout, meaning was this expectation? Do you think the Supreme Court did the right thing? Do you think this unwinds President Trump's attempt to, in fact, tip the scales to where things are in favor for the U.S.? Do you feel this is a bit of unwinding on that? Do you appreciate the fact that there's some checks and balances through Congress where they can in fact say, hey, you've overstepped your boundary here, or does this make this prohibitive to actually get things done? Love to hear your thoughts. As far as, again, the market reaction, we saw the positive reaction on Friday when that news was released. Nick, it's hard to disagree with you because I think one gray cloud that was over the markets, especially last year, was, again, we're going to sound redundant with this term uncertainty, but it's important to touch on that because I don't care if it's the stock market, bond market, real estate market, it's a flea market. they don't like uncertainty. Meaning,
no.
if there's curveballs or there's things that you can't really pinpoint or put your thumb on, that's generally when we see heightened volatility. And you could argue that this high level of tariffs and understanding what that was going to translate to for companies having to deal with that, it's been removed off of the table. So now that that's been removed off the table, I think the idea here now is that, hey, we'll get a little bit of a tailwind. These companies will be able to pivot and maybe get back to the level of operations that they were before they had to change that batter stance and get ready for that different pitch that was coming down the pike.
Well, and let's throw in the possible tax implications of the one big beautiful bill that was passed last year. I mean, we're already starting to see lower corporate tax implications. So we could see a huge financial tailwind, especially for some of these small caps.
Like tailwinds, not headwinds. This is the Real Money Pros. We got to take a break. Stay with us.
Make this year that you work smarter, not harder, with Ataraxis. As your strategic partner, Ataraxis becomes an extension of your business, taking the burden of HR, payroll, benefits, workers' compensation, compliance, and staffing off your plate. You'll have more time to focus on operating and growing your business. Let Ataraxis handle the details so you can focus on what matters most. Learn more at ataraxis.com. That's ATARAXIS.com.
As we age, managing our finances can become increasingly complex with ever-changing tax laws, estate planning, insurance needs, and investment environments. At Apollon Wealth Management, their goal is simple: to help enrich your life with personalized, expert financial advice. With a nationwide network of advisors, they're committed to delivering the best solutions for your financial future. It's time to take control and get the guidance you deserve. Connect with an advisor today by visiting The Real Money Pros. That's therealmoneypros.com.
Looking to make your dream of home ownership a reality? Look no further than Academy Mortgage, your first choice home loan lender. Academy strives to offer the best rates and terms tailored to your financial situation. At Academy Mortgage, you'll be treated like family, not just another file. Navigating today's ever-changing housing market can be challenging, but their team is here to help. Experience the zero-down options, including loans with no mortgage insurance. They also provide specialized medical professional loans and unique 2-to-1 rate buydowns that reduce your monthly payment for the first initial years of your loan. And forget about dealing with brokers and middlemen. With Academy Mortgage, everything happens in-house, from origination to funding. Say goodbye to hassles and surprises. Begin your home ownership journey today by visiting them online at academymortgage.com. That's academymortgage.com.
Academy Mortgage Corporation, NMLS 3113, is an equal housing lender.
Academy Mortgage, your first choice home loan lender.
This open enrollment, start making meaningful progress towards your long-term financial goals. Did you know that a health savings account, or HSA, is the most tax-advantaged account in the U.S.? Contributions are tax-deductible, which reduces your total taxable income. Withdrawals for eligible health expenses are also tax-free. And last, capital gains on investments are also tax-free. Did we also mention that it's free for individuals? Visit livelyme.com/pro today. That's livelyme.com/pro.
To the Real Money Pros.
And we are back. This is the Real Money Pros. Visit therealmoneypros.com. That's where you can get access to our educational content, our videos, our previous shows that we put in podcast form. Take our Better Buckets assessment. See how our bucket strategy can help you create a baseline foundation of why you're investing, what the purpose of your investments are for, based on a tangible financial target that has a timeline on it. The best way I can explain that is a meeting that I had with a client earlier this week, where it's essentially what these buckets do. It gives you a clean visual to understand how each dollar you have has a purpose. Meaning if we don't have a purpose for a dollar, that's where we get stuck in no person's land of it just sitting there and indecisions being made, and not making a decision actually is in fact making a decision. So it's just using a logical protocol to understand, okay, What is my desired outcome? What do I want to happen? What is a quality positive impact on my life, on my kids, my grandkids, whatever that case may be? Once we define that, then we're going to have a semblance of a timeline on that. Then we're going to have a clear indication of what your liquidity needs to be. Do we need to focus on more income generation? Not maybe you have a rental property. Nick, I want to talk about rental properties today because I've been having some interesting conversations around highly appreciated single-family rentals that are underperforming and a bit of a headache, but the hesitation to unwind from that is strictly the tax bogey that would result, or at least what these individuals had assumed the tax bogey is going to be. There's some strategies around that. But again, going back to the buckets, understanding, again, do we need to be more income focused? Meaning, okay, we don't necessarily need to focus on growth of assets. We need these assets to generate some type of passive income for us based on our cash flow. And we know that the interest, the dividends, the coupon payments, the rental payments, we have a clear projection of what those are going to be, when those are going to hit, which is feeding your lifestyle, your needs, wants, and wishes. And then we can determine, okay, what can we subject to more growth, aka more risk, because we know that we have proper time to let that thing stew. It's like a bar of soap. The more you touch it, the more it's going to dwindle around. So again, I will digress from that. But again, realmoneypros.com, better bucket system. Take the assessment, see how your money is in fact serving you. If you need a good advisor, again, reach out, use the Find an Advisor. We have great advisors across the country through Apollon Wealth Management, who is certainly partners of the show, partners of our firm. Fiduciary advisors here to work in your best interest, planning focused. The planning will determine how, in fact, your investments will operate.
Yeah, I mean, Jeremiah, you were mentioning in the first segment, that we use this term uncertainty all the time. Wall Street is always using the term uncertainty, but the better bucket strategy, what it does is, it helps you, first of all, understand uncertainty, but secondly, it helps you isolate uncertainty. Now, we'll never be able, even as advisors, we're never going to be able to remove 100% of the uncertainty from your life. But we can isolate it to certain segments of your financial picture, right? I mean, the whole reason why we have that first bucket is crucial, especially when you're going into retirement, is because it isolates your uncertainty really to your long-term bucket 3 money. In the short term, those first 3 years, you are completely insulated from uncertainty. You're able to do what you and your significant other have been talking about and dreaming about for decades. I mean, the peace of mind that it gives you, is it a guarantee? Let's be honest, no. It is not a flat-out guarantee. But we can isolate that uncertainty to the segment of your resources that in all likelihood, it will not affect you in the short term. And that's huge. That's proper planning and strategy, and it makes a significant difference in people's lives. I've got a client about every 3 to 4 months. We have a review. She's a widow, and it was an unexpected premature passing for sure because they're both they were both in their early 50s. And it was one of those scenarios, very, very common, where one spouse on top of the finances loved it, always paid attention to it, and the other spouse was just the free bird, just living, spending, enjoying life, having fun. You want to what? Well, it was the spouse that was on top of it that passed. And so because there's habits of never paying attention to it and not needing to understand it, we have to meet very frequently because I'm constantly re-educating the surviving spouse and reaffirming, like, listen, you are actually left in a really good position. But I have to reaffirm, here's why we don't go to cash when you start looking at things on the internet or hearing something on the radio that makes you bite your nails and say, I think I need to be completely out of the market. Here's why we don't. Remember, you were already set up. Like, you don't need to work. But you told me you think you'd be too bored. You need something to keep you busy. It's been about 1.5 years now since her spouse's passing. And she's telling me, I don't know that I want to work anymore. Well, remember, we planned for this. You can walk away today and your lifestyle is not going to change for 3 years. And that's not getting out of the market. Like, we're already positioned for this. We knew this day could come. We're already there. It just pays. All I'm saying is it pays to go to the website, take that Better Bucket assessment, and see how it can help you.
If you have questions, any thoughts, comments, and you don't want to ask that question live on air, send us an email, Jeremiah@therealmoneypros.com, Nick, N-I-C, at therealmoneypros.com. We will get you a response. One real quick thing to talk about, alluding to the buckets and preventing yourself from categorizing yourself as, I'm a conservative investor. Meaning I'm ultra conservative. So meaning since I gave myself that definition, I cannot in turn allow my money to be subject to any volatility. I'll give you a prime example where that could work against you. Clients that I worked with, and I think I was talking about this on the show maybe 2-3 weeks ago. Clients that I work with, we've been working with them since about 2016. Blue collar, worked for the city. Just did all the right things. I mean, basically, nothing crazy. Didn't live high on the hog, but they didn't live meagerly. They did the proper forecasting, delayed gratification, all of that. Met with them in 2016. Retired about a year and a half later. We made sure all the cash flow was dialed in. We bucketized all their accounts, making sure that they have plenty of liquidity, protection. But what have we seen since 2016? We've seen incredible market gains, and I can give you these 10. And there's one thing to talk about bull market, percentage of returns, whatever. I think what's important is actually how does that translate into real life? I'll give you a prime example. Throughout these years, I forget the exact years that we hit these marks, but I reached out like, hey, we're seeing these accounts do this, but we got some extra land. We're empty nesters now. Kind of like the idea of buying horses. Can we do it? Come on in. Let's game plan it. Bought the horses. Hey, the horses, we need like a covering. We need to do this. We need to do this about a couple years later. Looking at this, can we make it work? Yeah, come on in. Yep, we can make it work. Of course, a few things on top of that too. And now they're going to buy a RV. Like, pretty nice one too. Pretty nice RV. And it's like, same conversation. Hey, does this work? This seems like crazy. We got a crazy idea. No, in fact, it's not crazy. Go get it. They're going to Pittsburgh to go pick it up this weekend. So that's how the market can be a benefactor to you. But you also understand that risk-reward relationship, not letting emotions get in the way, that's where the bucket system comes into play. This is The Real Money Pros. We've got to take a break. When we come back, let's talk about economic output and interest rates. Apollon Wealth Management has transformed the way our team delivers financial advice. With their support, we're more equipped and more empowered than ever to provide top-tier financial planning, investment management, and personalized financial guidance. Apollon has been a key partner in helping us achieve our clients' unique financial goals. Whether you're an advisor looking to enhance your client experience or an investor ready to take your wealth management to the next level, reach out today to The Real Money Pros by visiting therealmoneypros.com. Let's elevate your financial future today.
Your emotions can drive many decisions, but when it comes to money, they shouldn't be in the driver's seat. I'm Alex at Tree City Advisors of Apollon. We get to know you and your goals to build a holistic, time-based investment strategy. Investing isn't rocket science, but having the right partner helps you stay the course. Learn more about us at treecityadvisors.com or call us at 208-888-1244.
Advisory services offered through Apollon Wealth Management, LLC, DBA Tree City Advisors of Apollon, an investment advisor registered with the Securities and Exchange Commission.
As a financial advisor, I often see that many families I meet with end up paying way too much money in taxes. If a healthy family has an insurance plan with a low deductible but high annual premium, why wouldn't they look at a high deductible insurance plan instead? They could save on their premiums and put those saved dollars into a health savings account, also known as an HSA. It's the most powerful tax advantage account title available to us, so why not use it? Take advantage of pre-tax money that could be grown tax-free and then use tax-free for all of your qualified healthcare expenses. That's why you need Lively. Our favorite because it's simple, fast, and free. I use it, my colleagues use it, and I recommend it to all of my clients. Visit Lively right away. You can even roll over your existing HSA money into this new plan and start saving right away. I know you're going to love the entire experience. Visit livelyme.com/pro today. That's livelyme.com/PRO. Lively is a proud sponsor of the Real Money Pros.
Begin your home ownership journey today. Look no further than Academy Mortgage, your first choice home loan lender. And forget about dealing with brokers and middlemen. With Academy Mortgage, everything happens in-house, from origination to funding. Say goodbye to hassles and surprises. Their team of seasoned professionals will be with you every step of the way. That's academymortgage.com. Academy Mortgage, your first choice home loan lender.
Academy Mortgage Corporation, NMLS 3113, is an equal housing lender.
Imagine financial advice without a sales pitch to buy something, and imagine a long-term financial plan focused on your goals, not somebody else's, and the day that you can leave your broker because you know how to do things on your own. At Tree City Advisors, we do things a bit differently than our peers. First, we help you define your purpose for investing. We help you clean up messes or complicated financial issues from your past. We help you organize all your financial pieces into something manageable. We're a fiduciary-only firm, and we design simple strategies. And we teach you how it all works without clutter, confusion, or high costs. We can either do your investments for you, or we can teach you how to do them on your own. In the end, we empower you with knowledge, lower fees, and confidence. Welcome to Tree City Advisors. This is the way we think if financial advisors should work for their clients. At Tree City Advisors, we provide flat fee planning and training. We also offer full service asset management, and we employ do-it-yourself technologies. There's never a fee for an initial meeting or review, so let's get started. Learn more at treecityadvisors.com. Tree City Advisors is an SEC registered investment advisor.
Listening to the Real Money Pros.
And we're back. This is the Real Money Pros. Again, phone lines are open. We are live. There's a lot of financial talk radio that is available to you over the weekends. First of all, we appreciate you listening to us. Second of all, we are not trying to sell you a thing. We are fiduciary advisors, always acting in our clients' best interest, acting in our listeners' best interest. We're just here to give you education. We're a sponsor-driven program. So the one thing we do ask of you is please visit our website, therealmoneypros.com. You can get access to our great sponsors. These are sponsors that we have used personally, whether it's Ataraxis PEO, Apollon Wealth Management. And as we continue to gain sponsorship, you'll have that peace of mind that we've vetted them. Again, phone lines are open, 979-59-MONEY. That is 979-596-6639, therealmoneypros.com. You can send us an email, Jeremiah at therealmoneypros.com, Nick, N-I-C, at therealmoneypros.com. You can catch our live stream on YouTube at The Real Money Pros. If you want to see why we have faces for radio, go to the stream, and you will find out why. Nick, we were talking about last segment. Obviously, we covered the tariffs. We covered how the Supreme Court ruled that down. If you have thoughts on that, please call the program. Let us know. Is this a good thing? Is this a bad thing? Do you appreciate the fact that there's this separation of power, some checks and balances in place? We were talking about as well the better bucket system, how having a thought-out process of understanding what your investments are supposed to do for you helped remove that emotion. I got a lot of people bringing this up. Hey, aren't we overdue for a correction? Are we overdue for a bear market? It's like, well, statistically speaking, if you look at various timelines, if you're using that as your metric of determining if we're overdue, then yeah, maybe. We know these things happen. No one has a crystal ball. We don't know exactly when, but I can certainly say this. I think it would benefit everyone out there, whether you're in retirement, approaching retirement, or years away from retirement, understanding if that does happen, it does not derail your plan, meaning you are in great shape. You've done the protocol to make sure that if that does in fact happen, it doesn't completely blow the strategy. And with the markets not too far off all-time highs, I would argue this is a perfect time to do it. Not when the market starts to turn over. This is the time when you want to reevaluate. But Nick, going in the last segment, you brought this up where working with clients where the spouse who had an early passing, unexpected death, he was at the helm for the household finances.
Right.
Which, I mean, to be clear, that's how I run our household finances with Tatum. It's not like she's unable or really doesn't want to. It's just kind of how things naturally flowed. And to be honest, it's the business I'm in, my career. I can put it this way. My wife was doing handmade jewelry for a number of years. And yeah, I probably would not pick that up. Like I would not go and doing handmade jewelry, right? So it's just how our house flow works, right? It works, it's great. But if something were to happen to me, then yeah, she would need to pivot and obviously come to our team here and either work with yourself, you, Nick, or Alex, or whoever, and say, hey, I need some help here. I need to get recalibrated because over the years that hasn't been the case. And if you're in that position, that's fine. But now we can kind of translate into, okay, let's talk about the estate planning. Let's talk about things that are almost arguably just as important as the investments, maybe even more so, because that's a certainty in life, is that you will have an end of life. And it doesn't mean that the obligations go away just because you're no longer above ground. It's important. And obviously there's tax efficiencies that roll into that, and when you're just looking at the basic piece of like probate, making sure that goes smoothly. There's just all things that need to be taken into consideration.
Yeah. I mean, I had a meeting just this week with a young couple. I meet with them about once a year over the last, I would say, 3 or 4 years. And basically it's like an annual checkup. Just, hey, are we still doing the right things? Give me an update on your life. What's going on? Well, they got married about 6 months ago. And so one of the things I was checking in on them was like, hey, beneficiaries on your 401k, on your 403b, have you changed those? Are those updated? Bank accounts, have you added TODs? And in their scenario, what works for them, he's got his bank accounts, checking and savings. She has hers, checking and savings. And then they have a joint that all like household bills are paid out of. Pretty common, actually. I see that a lot. I'm just saying, hey, add a TOD. I'm not telling you to make everything joint, but just add a TOD. It makes it super simple for the surviving spouse to get access to resources that they might need right there in their short time. These are simple little things in your broad estate planning that are very easy to do and very often overlooked.
So let's talk about TOD account titling. What does that actually mean? And I will use myself as the example here, but let's imagine that I have just an account. I don't care if it's an investment account, a savings account, a checking account, whatever the case is. If I went to that institution, Fidelity, Schwab, or if it's a bank account, Chase, Wells Fargo, local credit union, whatever it is, and I just go in there on my own and I say, hey, I want to open this account. Great. This is just going to be you on the account. Yes. So all the tax reporting is done to my name. That account access can only be done by me, all of that. If I do not designate a beneficiary on that account, which is usually under the term TOD, which is transfer on death, or POD, payable on death, if I do not designate someone in that regard, then if I pass away, that has to be probated. It has to, usually, I mean, I know certain states that have small estate affidavits, so take that with a grain of salt, but generally speaking, if that estate is over a certain level, you need to go through the legal proceedings of probate, which then gives you the legal authority to then go to that institution, again, whether it's a bank or a brokerage or whatever, and say, hey, the owner passed away. I went through the whole process. They have assigned me as having authority, generally the executor or executrix, to be able then to distribute that account per how the whole probate process is proceeding, right? So if you have a POD or TOD designation on that, then that doesn't need to go through probate, meaning it's a contract between you and that institution where if you pass away, and then my wife Tatum is, in this example, a beneficiary on that account, she can then go to that institution and say, hey, Jeremiah passed away. Here's the death certificate, which provides legitimacy that I am, in fact, passed away. And they'll say, okay, you're the beneficiary on this account. Can you provide us your information? She'll have to identify herself as, Tatum Bates, yada, yada, yada. And then now that account is in her control. Now, another alternative route to that is if it was set up as a joint account. So if that account is set up between Jeremiah or Tatum, this is where titles become extremely important, where if one of us then passed away, it's joint, meaning that you don't need to worry about the beneficiary designation and all that with the spouse. It just carries on to you.
It's seamless if you do it that way.
So there is some a lot of times when you hear the term estate planning, thoughts immediately go to wills or trust. And let's talk about those because those are extremely important. But not necessarily, meaning there's low-hanging fruit that you can go do literally today, probably online, by logging into your life insurance, logging into your 401ks, logging into your brokerage accounts, logging into your investment accounts. I don't care what it is. Go do a beneficiary audit. Make sure the right people are in the right place. And if that account is a single-owned account, it's like, you know what? I should probably, this is like our main transactional account. Like if we don't have to probate this away or like have to go and do a beneficiary designation and all that, maybe update that to a joint designation. I can't tell you how many times I've seen that where beneficiary designations are out of date. Now, when we're looking at IRAs, let's talk about a Roth IRA, a traditional IRA, or a 401k. Those are ineligible to be held in joint name. They have to be owned by you. So now we're talking about who is the beneficiary, who you're going to put in line next to receive it. And generally speaking, it'll be your spouse. And then you can put contingent beneficiaries on there, meaning if you and your spouse are both, like if Tatum and I passed away, a bad car accident, and we have a contingent beneficiary where, again, it's a contract with, is it Schwab? I think it's Schwab, okay? I got a couple accounts, but let's just say Schwab, right? So meaning whoever we put as contingent beneficiary, they would then go to Schwab, and that is a contract between Schwab. So Charles Schwab will have that process because, again, they're the custodian of the account to identify and then release that account to whoever is listed as beneficiary.
And on that note, it is important to remember in your estate planning that's a contractual obligation. Your primary beneficiary and your contingent beneficiaries, that's a contractual obligation in your scenario, Jeremiah, between you and Schwab. You could have something written up in your will. You could have something written up in your trust that says otherwise. Schwab is on the hook to obey the contractual obligation they have with you. If the primary, so case in point, not that this would ever happen, but let me play devil's advocate. You pass away and Tatum thought she was the primary beneficiary on the 401k. And it was somebody else.
My mom.
Your mom, okay. If you have a will or a trust in place that says the 401k goes to Tatum, but if it's listed as your mom as the primary beneficiary, your mom's getting those dollars, not Tatum, and there's not really anything that Tatum can do about it.
Important logistical items to make sure that what you want does in fact actually happen. I geek out on this topic when we're talking about the proper setup. When we come back, we're up against a break. We got to take a break. When we come back, let's talk about trust. Let's talk about the wills. Let's talk about the difference between those and the importance of titling your assets, especially when you have a trust-based plan. A lot of mistakes that can be made there. We'll be right back.
Businesses today face a barrage of challenges. They hunt for top talent, the search for the right benefits package, and the ever-rising tide of healthcare rates. And putting together the right team to run your HR-related tasks can be expensive, let alone time-consuming. Enter Ataraxis PEO, your professional employer organization ready to tackle all your HR needs from payroll to benefits administration, payroll services, workers' compensation, and talent recruiting. They've got you covered. With Ataraxis, you gain access to a team of experts who handle the nitty-gritty of HR, freeing you up to focus on what you do best, growing your business and growing your revenue. Ataraxis takes the time to learn about your business, crafting personalized solutions to help you and your team succeed. So say goodbye to the stress of HR administration and hello to Ataraxis. Experience the power of a true business partner with Ataraxis PEO. Visit ataraxispeo.com. That's ATARAXISPEO.com. Ataraxis, elevating businesses for the benefit of all.
Have you ever met with a financial advisor looking for some advice just to leave being sold an annuity you didn't want? At Tree City Advisors of Apollon, we do things a bit differently. We focus on your financial goals, helping you fix past mistakes, simplify your current finances, and plan for the future with confidence. Your first consultation is always free and without obligation. Visit TreeCityAdvisors.com and start your journey to financial freedom now. That's TreeCityAdvisors.com.
As a financial advisor, I often see that many families I meet with end up paying way too much money in taxes. If a healthy family has an insurance plan with a low deductible but high annual premium, why wouldn't they look at a high deductible insurance plan instead? They could save on their premiums and put those saved dollars into a health savings account, also known as an HSA. It's the most powerful tax advantage account title available to us, so why not use it? Take advantage of pre-tax money that could be grown tax-free and then used tax-free for all of your qualified healthcare expenses. That's why you need Lively, our favorite because it's simple, fast, and free. I use it, my colleagues use it, and I recommend it to all of my clients. Visit Lively right away. You can even roll over your existing HSA money into this new plan and start saving right away. I know you're going to love the entire experience. Visit livelyme.com/pro today. That's livelyme.com/PRO. Lively is a proud sponsor of the Real Money Pros.
To the Real Money Pros.
Welcome back. We are the Real Money Pros. Again, phone lines are open. If you want to change the topic, you want to talk about market, you want to talk about an individual stock, you want to talk about estate planning, taxes, which we're going to cover the next hour. Again, we're a live 2-hour program. You're likely starting to get a plethora of tax documents coming your way, 1099s, this and that. What are they? What are some things to pay attention to, especially with tax filing right now and right ahead of us? And some of you looking at extensions, what does that actually mean? We're going to talk about that next hour. But phone lines are open, 979-59-MONEY. That is 979-596-6639. Visit therealmoneypros.com. Subscribe to our newsletter. Get access to our great sponsors. Visit our previous videos and educational content. That is what we're here for. Or if you want to contact us directly, I'm Jeremiah Bates. He is Nick Daniels. Jeremiah at therealmoneypros.com. Send us an email. We'll read it. If you want us to answer that question live on air, we will. We have Nick at therealmoneypros.com. That is NIC at therealmoneypros.com. Okay, we're talking about estate planning. We're going to transition to trust and wills, the importance differences of understanding this, because, again, there's a lot of thoughts that go around, hey, when you hear estate planning, it's, will and a will, if I do this, then it makes it easier for my beneficiaries. We don't have to involve the court system and all that. It's not necessarily the case. Now, to be clear, we are not estate planning attorneys, okay? But we do understand that estate planning is such an important component to your whole financial plan, okay? I don't care what age you're at, if you're, younger starting in your career, if you're younger and you're starting a young family, you could argue those are the most pivotal points where I've noticed that young families, it's just they got so much stuff going on. That piece is usually put to the wayside, and you could argue that's an important piece. You have young kids, you got to make sure that, in my opinion, you got to make sure that piece is wrapped up, and you understand, hey, if something were to happen to both of you, making sure that financial obligation is handled. Whoever is going to take over guardianship of your kids, that's where you would insert that protection piece with life insurance, but also you and your spouse have that good conversation of who in fact is going to take over guardianship.
Yeah, I always bring it up with young couples, like, listen, right now a beneficiary audit probably going to take care of you. When you start having kids, now you need to look at a different level of estate planning, because the last thing you want is your state determining who is best fit to raise your children according to your value system. Wouldn't you want a final say in that? I thought so.
It's important. Okay, so let's talk about wills. A will, basically, at the end of the day, it is going to guarantee probate. It is a set of instructions that is going to go to the probate judge, through the probate process. And again, it's open to be contested. It's a public proceeding, right? That's why, when you look at this generally through that whole process, you have to make disclosure, usually in some type of publication, to notify that, hey, that person has in fact passed away. If someone feels that they have claim to something that person owned, meaning it could get messy. And Nick, you've seen it. I've certainly seen it. We've shared office space with estate planning attorneys. I mean, that probate process can get pretty ugly. Okay?
One of the best ways I've ever heard it phrased from someone who had to go through the probate process because there was only a will in place is they said, I felt like I was fighting for 18 to 24 months to get what was rightfully mine.
Yeah. Yep.
You're already dealing with the grief of losing the loved one, and now you're entering a battle for the next 18 to 24 months to get what is already yours. Now that's frustrating.
No, it is frustrating. But again, that's a big misconception where, again, if you have a will, I've heard this said many, many times. No, I have a will. I'm fine. Like it just everything passes through. No, that's not the case. I mean, if anything, it makes in theory, it would make the probate proceedings a little bit more smooth because you have a legal document, again, assuming it's drafted up the right way per your state laws and all that, it's all legitimate. In theory, that does give a little less friction in that probate process, and hopefully you arrive at that desired outcome that you have structured in your will.
Right. Think of it like this. Think of it as the will is the roadmap for the probate courts to help you navigate to the end goal.
Right.
But it doesn't remove the probate process. It's simply the roadmap guiding the judge, guiding your estate attorneys that you've engaged with to help you navigate that court system. It's the roadmap, but it doesn't quickly get you to the destination.
Which, again, you got to think of whoever you would assign in that will to basically run point for that probate proceeding. They're likely going to have to hire an attorney, which means you paid someone to do the will, and then you're likely going to pay maybe that same attorney, who knows, to then represent the probate proceedings. In some states, you also have to understand, too, some states actually, the attorney their payment is a percentage of the estate, right? So depending on what the size of the estate is, that's essentially how they're getting paid. So again, that's a state-by-state basis, so something to pay attention to. Now, if you go trust-based planning, the idea behind a trust is that it's its own living and breathing thing. Now, we're just talking about a living, revocable trust. We're not going to go down the wormhole, but if you want, we can talk about complex trust-based planning, revocable trust, charitable remainder trust. I mean, if you want to talk about how we can get pretty complex to be very tax efficient from an estate planning standpoint, we can certainly go down that route. But we're just talking about generally, hey, I own stuff. I have this, I have that, I have this, I have that. I want to make sure that this passes through to the people that I designate or the charities that I designate, and it does not have to go through a probate proceeding, meaning we're going to draft up this legal document done the right way where while I'm alive, aka the revocable piece, we can make changes to it. I can design who this account goes to, where this goes. And then when I pass away or me and my spouse pass away, it now becomes irrevocable.
Meaning no more changes.
No more changes, meaning the framework, the guidelines are set. Now you put players in place to actually make sure they execute what the trust actually dictates what you want to happen. You can have a successor trustee, a successor co-trustee, or maybe you have two people actually making sure that they're acting with what the trust says to do, right? So maybe it's one person, maybe it's two people. I would argue that you want to be very cognizant of who you put in that successor trustee role. A lot of people default to a child of who they deem as like the most financially responsible, but do your due diligence. I have seen in many cases that this can put some strain on family dynamics where, let's imagine you have multiple kids, you assign one as the successor trustee to manage the trust, and those siblings may be a little rubbed the wrong way, the fact that they weren't involved in decision making and now they're questioning everything. Like it could go awry. Just put it that way. All I'm going to say is just be aware of who you put in that position. So now you have a trustee. Doesn't need to be a family member. You could hire professional trustees, which are actually companies that are in that position to do that. And then you have beneficiaries. So meaning the trustee works within the language within the trust to make sure that they are settling assets, they're selling things that they need to sell, they're covering the tax obligations, they're covering this, they're covering that, final tax returns, all of that, and then they settle the estate per how the trust deems it, and then they make sure that that money is routed to the rightful beneficiaries. And sometimes that trustee can be the sole beneficiary. It just kind of depends on how you want to structure it. But the beauty of that process is this. There is no probate court involved.
It's private.
It's private because you had that asset. You had the house, you had the property, you had the business interest, you had the investment account, you had the beneficiary as the trust. So think of the trust as its own entity. It's like own living and breathing thing. While you're alive, it's an extension of you, meaning like for me and Tatum, we have a trust. We have a revocable trust. It's just an extension of us. Everything that we can title to it, it's titled to it, which is great. But if something were to happen to me and Tatum, now the trust has that asset. The trust owns it.
Yeah, the trust takes over.
The trust takes over. So meaning there's no other conversation to be had. There's no other outside party. I mean, there should be some cases, again, you got to look at the trust and make sure it's drafted up accurately. So I want to make that little asterisk there. But the idea behind that trust is that there's no third party or outside voice that can come in and say, hey, well, what about this? It's like, well, the trust was done tight. The trust was drafted correctly per all the rules and regulations. It cannot be pierced, right? And the trust is going to dictate what happens to that asset. Trust-based planning could be a good option.
It's nice and clean when it's done right.
Nice and clean. That's what we appreciate. We are up against a break. We'll be back at the top of the next hour.
The Real Money Pros is hosted by Brian Wiley and other team members of Tree City Advisors of Apollon. Tree City Advisors of Apollon is a DBA of Apollon Wealth Management, an SEC-registered investment advisor and affiliate of the Real Money Pros. The Real Money Pros and Tree City of Apollon are not affiliated with any of the companies or non-advisor professionals participating on this program. Ataraxis PEO and Apollon Wealth Management are financial sponsors of the Real Money Pros. Additionally, Apollon receives advisory fees for these sponsors and or their representatives for investment advice. Log into therealmoneypros.com to contact the host for advice, show archives, educational material, and more. This program is brought to you by the quality sponsors heard within this broadcast.
Businesses today face a barrage of challenges. They hunt for top talent, the search for the right benefits package, and the ever-rising tide of healthcare rates. Ataraxis takes the time to learn about your business, crafting personalized solutions to help you and your team succeed. Ataraxis partners with businesses of all sizes and industries. Their mission? To reduce the stress and risk that comes with business owners trying to do it themselves. Visit ataraxispeo.com. Ataraxis, elevating businesses for the benefit of all.
Your emotions can drive many decisions, but when it comes to money, they shouldn't be in the driver's seat. I'm Alex at Tree City Advisors of Apollon. We get to know you and your goals to build a holistic, time-based investment strategy. Investing isn't rocket science, but having the right partner helps you stay the course. Learn more about us at treecityadvisors.com or call us at 208-888-1244.
Advisory services offered through Apollon Wealth Management, LLC, DBA Tree City Advisors of Apollon, an investment advisor registered with the Securities and Exchange Commission.
Are you a do-it-yourself investor looking for ideas from a pro, but not necessarily interested in hiring a pro? Well, I have something to share with you. I build investment allocations for my clients on a daily basis, but sometimes people simply ask if I will share my ideas with them. My answer? Sure. The way I see it, I'm lucky these people consider me to be an expert. So I started writing a quarterly newsletter with model portfolios built for different purposes. My readers get to decide if they want to follow any or some of my ideas. Now, powered by freedomfolios.com and the use of their TD Ameritrade account, my followers can get their investment portfolio in line with my suggestions with the simple push of a button. Using the freedomfolios.com technology is simple and it's fast. I update my models once a quarter, and freedomfolios.com then sends my subscribers a message via email or text letting them know that they may want to update their investment accounts. It's the least expensive way to get professional models without the cost of a pro. Visit freedomfolios.com. See my models there. You can start your free 30-day trial right now. It's freedomfolios.com.
You've been waiting a little bit longer longer than normal?
Jen's manicure spot needs an extra pair of hands.
Who's at the front desk right now?
Someone who's handy with everything from nail files to spreadsheet files.
Deidre's not coming in today, but we have that whole bachelorette party.
Indeed can help her hire great people fast.
I need Indeed.
Indeed you do. Instant Match instantly connects you with quality candidates whose resumes on Indeed match your sponsored job description. Visit Indeed.com/credit and get $75 towards your first sponsored job. Terms and conditions apply.
To offer valuable advice and earn clients' trust as an advisor, it's essential to always put their interests ahead of personal gain or the preferences of any particular company. Advisor Insurance Solutions is dedicated to delivering insurance solutions from an advisory perspective. They provide objective and unbiased insurance planning, making it an integral part of their comprehensive advisory process. If you're looking for insurance guidance that aligns with your financial goals, visit therealmoneypros.com. That's therealmoneypros.com.
Are you in the market to buy a house or just looking to refinance your current mortgage? For helping individuals and families achieve affordable homeownership, Academy Mortgage is a first choice. And when finding that perfect loan for the perfect home, you need a company that will treat you like family, not just another file. To help you navigate through today's ever-changing housing market, Academy Mortgage has zero down options available to you. That includes zero down with no mortgage insurance. We also offer medical professional loans and 2-1 rate buy-downs that help lower your monthly payment for the first several years of your loan. Origination, processing, underwriting, and closing and funding will all happen in-house. With over 34 years in the business, we know that buying a home is more than just a house. That's why it's important we protect our customers and safeguard their financial wellness for years to come. Visit us online at academymortgage.com today to start your journey to homeownership with Academy Mortgage. That's academymortgage.com. Academy Mortgage, your first choice home loan lender.
Academy Mortgage Corporation, NMLS 3113, is an equal housing lender.
Nobody protects you from mayhem like Allstate. I'm a speed bump. Did you hear what I said? I'm a speed bump. And if you have cut-rate car insurance, the cost to reattach your muffler could really be a bump in the road. So switch to Allstate, save money, and be better protected from mayhem, like me.
Based on coverage and limits selected, subject to terms, conditions, and availability. In most states, prices vary based on how you buy. Allstate Bar and Casualty Insurance Company and affiliates, Northbrook, Illinois.
Running out of gift ideas for your loved one? Send flowers with Flower Fix. And need to create joy in your living or workspace? With many working from home these days, create joy in your space with flowers. Flower Fix is a subscription-based flower delivery service perfect for birthdays, anniversaries, or any special occasion. We offer 2 subscription options to choose from, a text-based subscription or a traditional one. Enjoy these big, beautiful hand-designed bouquets that are delivered straight from our flower fields to your door. Log on now, www.flowerfix.com, to choose your flowers today. Have control over when you want flowers delivered. Weekly, bi-weekly, monthly? Get your flower fix at flowerfix.com. Use code FlowerFixPro to receive 20% off your first order. flowerfix.com.
Hi, I'm Stephanie Gallegos with Price for Life. Do you have a life insurance policy that you'd like to sell? If you don't need the coverage anymore or would rather not keep making the premium payments, visit our website, priceforlife.com. Don't let your policy lapse when you can potentially get a cash payment for it. There are several reasons why a life settlement might be a great value to you. Perhaps your policy is too expensive, or you feel you no longer need the death benefit, or you may think you need to wait until death before your family can get the money from the insurance company. This is why you may want to consider a life settlement. Price for Life has excellent resources available along with a free evaluation process to help you understand the value of your policy and the options available to you. Price for Life's clients have received hundreds of thousands of dollars for their policy when they would have otherwise just let it lapse by stopping the premium payments. Get the compensation you deserve. Visit priceforlife.com today and fill out the case evaluation form to see if your policy qualifies. That's price4life.com. priceforlife.com.
Healthcare expenses can be a burden, so why not make the most out of the money that we'd spend anyway? Take advantage of the most powerful tax advantage account title available to us, a health savings account, also known as an HSA. That's why you need Lively. Visit Lively right away. Open your HSA, roll other HSA money into that new plan, and then start saving. I know you're going to love the entire experience. Visit livelyme.com/pro today. That's livelyme.com/PRO.
Real Money Pros is brought to you by The Real Money Pros and the sponsors heard within this broadcast. Material presented on this program may not be suitable for you. Consult a registered investment advisor when evaluating any particular investment, security, or investment strategy. The views, opinions, or advice offered by the hosts and guests do not necessarily reflect those of this station. Brian Wiley and Jeremiah Bates are investment advisor representatives with Apollon Wealth Management, an SEC registered investment advisor. The Real Money Pros with Brian Wiley and Jeremiah Bates, the weekend's smartest money show. Investing, taxes, legal topics, insurance, and every other confusing money topic made simple.
And we're back. This is the Real Money Pros, hour number 2 of our 2-hour live program, which means that you can interact with us. Call us, 979-59-MONEY. That is 979-596-6639. I am Jeremiah Bates. He is Nick Daniels. We are fiduciary financial advisors. Any topic you want to cover, fair game. The last hour, we talked about the tariffs, the Supreme Court essentially shutting down President Trump's ability to enact those tariffs under the IEECA?
International Emergency Economic Powers Act.
Okay, PA. I was close. What are your thoughts? I mean, there was speculation all along that this was going to get shut down. Markets reacted positively, actually moved out of negative territory on Friday based on that news. Love to hear your thoughts if you have an opinion on it. We were talking about estate planning last hour, and we got a great email from one of the listeners, and I'm going to pull it up here so I can read it. Question is this: can you put your trust as the primary beneficiary on your IRA? I am unmarried and want my assets to go to a few beneficiaries.
That's a good question, first of all.
It is a good question.
It's a very good question. In general, I will say this. You need to understand that if you list a trust as the primary beneficiary on qualified retirement accounts, specifically like this IRA, the distribution rules apply differently than if you actually name individuals. So if it's not a spouse inheriting an IRA and certain other qualifying people inheriting an IRA, typically that recipient has 10 years to bring their account value, like whatever percentage of that IRA that they get. It sounds like in this email, it sounds like there might be like more than one person that they would intend to benefit from this IRA. So each person's going to receive a portion of that. If they're named specifically, they're going to have 10 years to drain that account down to zero. Doesn't mean they have to spend it, but they have to move those dollars out of the inherited IRA. They can move it into their own IRA. They could move it into a non-qualified investment account. They could just take the money and spend it if they wanted to do that. But the rules say that they have 10 years from that person's passing to get their inherited account down to a $0 balance. Trusts have 5 years to do that.
With an asterisk next to trusts. If it is, in fact, a see-through trust, and there's some rules that actually have to be checked off the box for it to fall under that see-through trust designation. But a couple pieces: it needs to be valid under state law. It needs to be irrevocable at death. And there's some nuances to this, right? But there has to be what's called identifiable beneficiaries. And I believe there's certain criteria that needs to be met. Like, meaning if you just have them going to like identified individuals, like you actually name the person, like you'd identified in there, then you're pretty much going to be on track for that trust to be deemed as a see-through trust. But if you have like certain businesses or routes to certain things, I think then it loses its ability to be earmarked as a see-through trust. But to your point, Nick, this kind of leads back to the question of, well, should I put my trust as the primary beneficiary on your IRA? And there's some follow-up questions that need to be asked, because you did a great job explaining, hey, we're subject to this 10-year rule now if the beneficiary is not a spouse. And the person who emailed this question had a great point. Said, I'm not married. So again, if this listener is not married and continues not to be married, then they likely will not have a spouse if she were to pass away that will receive that IRA. And it sounds like she's got a couple beneficiaries. She said, I have a few.
Correct.
Wait, my 7-year-old daughter always asks me this, by the way. This is pretty funny. It's like this next iteration of life for her where I'm like, she's like, when are we going to do this? Or when's this? I'm like, couple minutes. She's like, well, how long is a couple minutes? I'm like, I don't know. A couple's a couple. Between 3 and 5. I don't know what does
A couple is 2, a few is 3.
Okay. So
that's my opinion.
Okay, perfect. So now let's imagine that it's a few, so 3 people. Like she's got 3 people in this scenario where it's like, hey, I got an IRA. I also have a trust. I have 3 people that I want this IRA to go to. In that case, it'll be, in my opinion, logistically easier to just assign those 2, those 3, those 4 direct individuals as a beneficiary to that IRA. Because here's the deal. I've seen, and this is where we talk about the actual logistics of this and working with a custodian. If you have a trust, that there's a lot more moving parts that goes to that. When it comes to, let's say it's a Fidelity, a Schwab, or wherever you hold that IRA, they got to read through the trust. They got to da-da-da-da-da. They got to look at this. They got to look at that. Versus if you just put the individuals, they just go identify themselves. They'll set up what's called an inherited IRA for that individual where that money would go into, and then they can do whatever they want with it, right? They can take the money out. They can follow that. If the owner of that IRA was of RMD age, they continue to do those annual RMDs. They could take a little bit out each out year. But ultimately, when they get to that 10 years, they just want to make sure that they remove all that money out of there so they don't get hit with that penalty.
Yeah, and I've seen where the trust is listed, then even what you're talking about, like sometimes with the see-through or pass-through trust, like sometimes the custodian is going to have very unique hoops to that custodian to jump through, where you've got to open up a trust account first, then it's got to get there. So everything's got to get journaled over. Then from the trust, it gets journaled over to other accounts that are then set up. I mean, I side with you in this particular email, Jeremiah. The simplest and most efficient is usually the best way to go. Name those specific people as primary beneficiaries. Designate the percentages of that IRA you want each person to receive. That percentage has to total 100%. Doesn't have to be equal amounts to those people, but the total percentage has to equal 100%. Instruct your custodian to do so. That's the cleanest.
Agreed. But if we wanted to answer the question directly, can you put the trust as the beneficiary on that IRA? Yes, you can. But the next question in this kind of order of operations we're doing, should you do it? And it's going to be the answer that everybody loves is it depends. It depends on who the beneficiaries are. It depends on what you like. There's some questions that we'd want to dive deeper into so we can have certainty on that answer, whether you should do it or not, based on the limited information we have and the assumptions that we're putting out there. Based on those assumptions that we're doing, in my opinion, it'd probably be cleaner and easier and still get that same result to just list those individuals directly as beneficiaries. And here's the thing, you could put them as primary and then you could put the trust as contingent. That could be an option there where if for whatever crazy reason all those primary beneficiaries just said they didn't want it or they
precede you in death.
They precede you in death, and the trust is kind of that catch-all that you have there.
Yeah, which makes me think this is why it's really important that the professionals that you have in your life, your financial advisor, your estate attorney, your tax professional. Oftentimes, like if you're using someone to, your insurance professional, someone that's helping you put life insurance in place, an umbrella policy in place, whatnot. It's really important that, first of all, you have a good relationship with all of them as an individual. There's got to be a high level of trust with all these people that you're entrusting your financial livelihood to and your future estate to. But then you also want to find those professionals that are willing to engage with each other on your behalf. Talk to each other, whether that's call or email. I mean, if you've got a tax professional that's not willing to have a conversation with your financial professional, your advisor, why? Like that, to me, that's a red flag. Like, let's collaborate on behalf of Mr. and Mrs. Client and make sure that we're making the best decisions, not just for current tax year, but for future tax years for the clients. Same thing with estate attorneys. Like, it really should be a collaborative effort to make sure that we're all working together to benefit you, because it's you. It's your money. So let's make sure we're all playing nicely.
that collaboration piece, I think when you actually, again, there's the theory of something, and then there's like the actual reality of it. And I like to give real life examples of how that concept, that rubber hits the road. And that was earlier this week, where it's a client that we've been working with for a number of years. We're close with the CPA who's handling all the tax side of things, close with the estate planning attorney. That client had a significant health event. And generally, as the advisor, we're meeting with these individuals more frequently, maybe not, more frequently than the CPA or the tax professional, usually more frequently than the estate planning attorney. Those are usually like on an as-needed basis. But for us, like, hey, we want to connect with you more so because we're directly tied to the ins and outs of their financial picture. But in this case, they had a significant health event that happened a few weeks ago, and it's changing their trajectory in a lot of things. We can run quarterback to those professionals and say, hey, here's what we talked about. It's a big benefit. We'll be right back.
Businesses today face a barrage of challenges. They hunt for top talent, the search for the right benefits package, and the ever-rising tide of healthcare rates. And putting together the right team to run your HR-related tasks can be expensive, let alone time-consuming. Enter Ataraxis PEO, your professional employer organization ready to tackle all your HR needs, from payroll to benefits administration, payroll services, workers' compensation, and talent recruiting. They've got you covered. With Ataraxis, you gain access to a team of experts who handle the nitty-gritty of HR, freeing you up to focus on what you do best, growing your business and growing your revenue. Ataraxis takes the time to learn about your business, crafting personalized solutions to help you and your team succeed. So say goodbye to the stress of HR administration and hello to Ataraxis. Experience the power of a true business partner with Ataraxis PEO. Visit ataraxispeo.com. That's ATARAXISPEO.com. Ataraxis, elevating businesses for the benefit of all.
Looking to make your dream of home ownership a reality? Look no further than Academy Mortgage, your first choice home loan lender. Academy strives to offer the best rates and terms tailored to your financial situation. At Academy Mortgage, you'll be treated like family, not just another file. Navigating today's ever-changing housing market can be challenging, but their team is here to help. Experience the zero-down options, including loans with no mortgage insurance. They also provide specialized medical professional loans and unique 2-to-1 rate buydowns that reduce your monthly payment for the first initial years of your loan. And forget about dealing with brokers and middlemen. With Academy Mortgage, everything happens in-house, from origination to funding. Say goodbye to hassles and surprises. Begin your home ownership journey today by visiting them online at academymortgage.com. That's academymortgage.com.
Academy Mortgage Corporation, NMLS 3113, is an equal housing lender.
Academy Mortgage, your first choice home loan lender.
I know you've been waiting a little bit longer than normal.
Jen's manicure spot needs an extra pair of hands.
Who's at the front desk right now?
Someone who's handy with everything from nail files to spreadsheet files.
Deidre's not coming in today, but we have that whole bachelorette party.
Indeed can help her hire great people fast.
I need Indeed.
Indeed you do. Instant Match instantly connects you with quality candidates whose resumes on Indeed match your sponsored job description. Visit Indeed.com/credit and get $75 towards your first sponsored job. Terms and conditions apply.
To the Real Money Pros.
We are back. Phone lines are open. 979-59-MONEY. That is 979-596-6639. We are live. Interact with us. Visit therealmoneypros.com. Use the Find the Advisor feature. We have a network of fiduciary advisors across the country that can help you. We're talking about trust. We're talking about estate planning. We're talking about the nuances of how inheriting IRAs work. Maybe you had a spouse who passed away and you're trying to figure out how to make sure all this thing flows the right way and you don't get caught off guard with any surprises. That's why we're here. We're here to help. So again, you can call us, have questions. These are questions that usually other people have top of mind as well. It's just great for the community. We're here to provide education. We're not selling you anything. We are a sponsor-driven program. So please go to therealmoneypros.com, take our Better Buckets assessment, get exposure to our great sponsors. That is the one thing that we ask of you. Again, 979-596-6639. Pretty volatile week on Wall Street, I guess. And I say that only because that we've had what you would argue a lack of volatility over the previous couple years. But hey, we had some economic data coming through. We had the CPE, which is the Federal Reserve's preferred inflation metric. We had the news break of the Supreme Court striking down President Trump's endeavor around executing those tariffs under that IEEPA. We had a positive reaction from the markets. But hey, Dow Jones Industrial Average, if you look at it year to date, finished still up over 3%. S&P 500 right around 1%. NASDAQ on the technology side of things, we've seen some lofty pricing of those stocks, particularly over the last year. We've seen a little bit of I don't want to go as far as rotation. I wouldn't even go as far as a pivot, but we've just seen maybe a little bit of rebalancing out of this high-flying tech sector to go in what you would argue is some more value-oriented assets, and that's why I think we're seeing the Dow Jones Industrial Average outperform the NASDAQ.
Yeah, I think AI is just frothy, and there's just a lot of it feels like the investor sentiment is just kind of frustrated now with the AI hype after a couple of years of just seeing these things skyrocket, and yet, we're seeing companies like Alphabet, like Meta, we're seeing them double down on their investment in AI, but we're yet to really see like the return on that investment on the shareholder side of things. I mean, like profits are good and all of that, but there's just kind of this, it's frothy, and the investor sentiment is sort of getting just worn out by all the AI hype.
Well, I think a lot of it has to do with that's the stock market is a discounting mechanism, meaning it's going to price a stock based on what that company's future profitability is anticipated to be. And for all intents and purposes, there's a lot smarter people out there than me, and people that are very well versed in that space, that there's an agreed upon sentiment that, hey, AI is going to be this revolutionary technology that could potentially change the way that we do everything. I'm not necessarily in this camp. I'm not saying that I'm not in that camp. I'm not, probably more middle of the road here as far as, I think there's it's on a good trajectory, and I do think it will change a lot of things, but you go in the ChatGPT or some of these large language models and you put in some basic stuff and it's just punching out clearly wrong information. Yeah. It's just so is that I do tend to take these things with a little bit of a grain of salt. But okay, so now we look at the performance of these sectors, if you will. And again, we've seen some down days for these type of stocks, and we've seen some big up days. But again, these earnings do need to be in line with where that stock price is. And if within these earnings reports or these news that's breaking from these companies, if the return on investment is starting not to meet those expectations, then we could likely see a repricing of that stock, which means that we see that sector start to get drugged down a little bit. And if you see that sector get drugged down, you're likely going to see these larger indexes go down because the representation in those indexes are just so what you could argue over-concentrated to those technology companies like your NVIDIAs, your Apples, and things like that. But one thing I will say about this, interesting about Apple. Apple was underperforming last year because some were saying that they didn't have an AI plan. Like, how are they really going to leverage this? And they're behind the 8 ball. But now you actually see Apple outperforming because they said, hey, our capital expenditures, we were not just throttling that down into just saying, hey, AI. We're being a little bit more measured. We're being a little bit more thoughtful in actually how we integrate it. And you could say that the issue was against the hardware side of things, with the Macs, the iPhones, and things like that. Now that's actually coming back in favor. So it's just interesting market dynamics that, is this pivotal or make or break into your overall financial plan? It just depends on where you're at. But again, with what we're seeing in the news and we're seeing in this market activity, listen, I don't think this is going to surprise anyone, or it's a hot take that a financial advisor says, expect some volatility. But I would say that. And, again, not getting into more of the commodity space. You look at the price of oil, that was up over 15%.
Yeah.
up over 15% year to date. Had almost a 6% gain this past week. Those geopolitical tensions with Iran, that paying close attention to that, put it that way.
Yeah, I mean, so just a few numbers here. I mean, this is why you're wanting a diversified investment portfolio. You want the opportunity to get gains.
So jargony, Nick.
Oh, I know. But listen, this is why you want to cast with a broad net so that you have the opportunity to catch gains wherever you can find them. Energy sector is up over 21% so far year to date. Materials up 11.7, industrials up 12, consumer staples up 11.3, utilities up around 8% year to date. Laggards, technology down around 3.4%, financials down around 2.3%. So, you just got to you got to cast a broad net.
And don't sleep on international. International continues to outperform U.S., which has not been the case over the past years, but last year certainly was the case. We're seeing it in the early stages of 2026 as well. So, again, the takeaway on that is diversification. This is not a new concept. This is something that has withstood the test of time for successful investors, and the idea is not putting all your eggs in that one basket, right? I love the saying, cast a broad net. Again, phone lines are open, 979-59-MONEY. That is 979-596-6639. Tax time is upon us. You're likely starting to get emails. You're likely starting to get mailers that are representing the taxable activity that happened in your accounts, that happened through your sources of income, or you're self-employed, you're getting your books cleaned up, you own a rental property, you're making sure that the expenses are properly allocated for versus the gross income. It's the most wonderful time of year.
Yeah. One thing, I mean,
I didn't do a good job with my sarcastic tone on that, but what
I was just gonna say, one thing I would encourage the listeners, if you own non-qualified accounts, whether it's titled as an individual account, a joint account, and you have investments that are paying any sort of a dividend throughout the year, throughout 2025, actually, honestly, like if you owned mutual funds that had gains, but maybe the fund managers did some tax loss harvesting at the end of the year, don't be in a rush to take the very first 1099 that you get off of your non-qualified account, take it to your tax professional and say, here it is, I'm good to go. Inevitably, there will be a corrected 1099 that's going to come your way. I keep encouraging my own clients, just be patient. Let's wait for the corrected ones to come out. You want to review those ordinary dividends. You want to look over those numbers, make sure that there's nothing glaringly outrageous on those, nothing that looks very, very strange compared to prior years, because they're not always perfect. Even the custodian can make a mistake. It is your job to review your money and take a look at it.
Yeah, it's well said. So you're getting 1099s. What should you pay attention to? If there is a mistake, what are the steps that you should take? Tax time is upon us. Let's make sure we're proactive. This is the Real Money Pros. We'll be right back.
As we age, managing our finances can become increasingly complex with ever-changing tax laws, estate planning, insurance needs, and investment environments. At Apollon Wealth Management, their goal is simple: to help enrich your life with personalized, expert financial advice. With a nationwide network of advisors, they're committed to delivering the best solutions for your financial future. It's time to take control and get the guidance you deserve. Connect with an advisor today by visiting The Real Money Pros. That's therealmoneypros.com.
Did you have a tax strategy going into this year to help maximize your tax savings? I'm Jeremiah Bates with Tree City Advisors of Apollon. We consider key factors like required minimum distributions, Social Security, net unrealized appreciation, 1031 exchanges, and more. Because a good advisor should help you with more than just investment selection. Visit us today at treecityadvisors.com or call us at 208-888-1244.
Advisory services offered through Apollon Wealth Management, LLC, DBA Tree City Advisors of Apollon, an investment advisor registered with the Securities and Exchange Commission.
As a financial advisor, I often see that many families I meet with end up paying way too much money in taxes. If a healthy family has an insurance plan with a low deductible but high annual premium, why wouldn't they look at a high deductible insurance plan instead? They could save on their premiums and put those saved dollars into a health savings account, also known as an HSA. It's the most powerful tax advantage account title available to us, so why not use it? Take advantage of pre-tax money that could be grown tax-free and then use tax-free for all of your qualified healthcare expenses. That's why you need Lively. Our favorite because it's simple, fast, and free. I use it, my colleagues use it, and I recommend it to all of my clients. Visit Lively right away. You can even roll over your existing HSA money into this new plan and start saving right away. I know you're going to love the entire experience. Visit livelyme.com/pro today. That's livelyme.com/PRO. Lively is a proud sponsor of the Real Money Pros.
If you have a small business, Staples has your sign.
Banners for my bakery?
Staples has your sign.
Oh, posters for my new pet store.
Floor decals for a pharmacy.
Every day, Staples associates help every kind of small business create bold signs to make big impressions. And now get $10 off custom signs, banners, and posters when you spend $50 or more. This is your sign, so print it big at Staples. Ends 5/28. Visit staplesconnect.com/thisisyoursign for details.
Imagine financial advice without a sales pitch to buy something, and imagine a long-term financial plan focused on your goals, not somebody else's, and the day that you can leave your broker because you know how to do things on your own. At Tree City Advisors, we do things a bit differently than our peers. First, we help you define your purpose for investing. We help you clean up messes or complicated financial issues from your past. We help you organize all your financial pieces into something manageable. We're a fiduciary-only firm, and we design simple strategies. And we teach you how it all works without clutter, confusion, or high cost. We can either do your investments for you or we can teach you how to do them on your own. In the end, we empower you with knowledge, lower fees, and confidence. Welcome to Tree City Advisors. This is the way we think if financial advisors should work for their clients. At Tree City Advisors, we provide flat fee planning and training. We also offer full service asset management, and we employ do-it-yourself technologies. There's never a fee for an initial meeting or review, so let's get started. Learn more at treecityadvisors.com. Tree City Advisors is an SEC registered investment advisor.
You're listening to the Real Money Pros.
Welcome back. This is the Real Money Pros. Jeremiah Bates, joined with Nick Daniels, fiduciary financial advisors. If you have a financial topic that you want to discuss, call the program, 979-59-MONEY. That is 979-596-6639. You can send us emails if you want us to answer a question live on air. Jeremiah, all 4 syllables, at therealmoneypros.com. Nick, N-I-C, at therealmoneypros.com. Visit our website, therealmoneypros.com. It's where you can get access to our sponsors. You can find an advisor in your area. We have a network of fiduciary advisors across the country. Again, we're here to provide education. We're not here to sell anything. We act in the best interest of our clients. We're acting in the best interest of our listeners as well. Now, what will be in your best interest is to be your own advocate, and this is the case that I'm finding the older that I get. You have to be your own advocate in many aspects of your life. I didn't know I had to become a medical billing coding expert last year, but I found myself having to do that because running into frustrations with how that whole system operates or lack thereof. Point being that we're getting tax documents, some things that you need to pay attention to. And one thing that I've seen is, let's imagine you're getting a 1099 from your custodian. Maybe it's a Fidelity, a Schwab, an E-Trade, whatever the case is. If you have an IRA, let's just say it was a traditional IRA that you were actually doing distributions out of to your bank account for you to then spend that money, or you were doing a Roth conversion, that's going to be a 1099-R. And that 1099-R is basically just going to show that gross amount of money that you took out of that account, and that's going to be added to your taxable income through the year. Now, if you did some tax withholding on that distribution out of that pre-tax account, that 1099-R is also going to say, okay, well, here's how much you already sent to the IRS, and here's how much money you may have sent to the state. You'll see that amount in there. So then whether you're self-preparing your taxes or giving these tax documents to your tax preparer, your CPA, they just put that into the software, and all that's taken into consideration, right? The point that I'm getting at is this, and I've seen this happen with a handful of clients that I've worked with over the past couple years. is that we're doing these backdoor Roth conversions. And an easy way to explain that is this. You want to do a Roth contribution, but you make too much money to do a Roth contribution. The IRS sets income limits on how much, if you're eligible to actually do a direct contribution into a Roth IRA. Now, there's an easy tax loophole to get around that. Essentially, you do a contribution into a traditional IRA. You do not deduct it on your taxes, meaning that money that went in there did not reduce your taxable income. You put it in there as a non-deductible contribution, and then you do a Roth conversion, meaning you can convert money from traditional IRA to Roth. Bada bing, bada boom, an easy way, tax loophole for high-income earners to continue to contribute into the Roth. But you also got to understand the logistics of the tax reporting that happens. You did a Roth conversion. Wherever you did that Roth conversion or that non-deductible IRA contribution, they're not going to know it's non-deductible. They don't know. They just know, hey, Nick Daniels did a traditional IRA contribution in 2025. Now, Nick knows in the back of his head that it was a non-deductible, and that is trued up on his actual tax return when he files.
Correct.
But that custodian doesn't know. So when they generate that 1099-R, if Nick doesn't relay that information to his accountant or CPA, or when Nick is self-preparing his taxes, if he's not mindful of making sure that it's booked as a non-deductible contribution, he's going to get, it's going to show as if that he earned another $7,000 of income. And oh, by the way, since he's under 59.5, they might say that, oh, you owe a penalty because you did an early distribution out of your IRA.
Right. Understand this. Like the custodian, I'm just going to use Schwab. The custodian, Schwab, they're simply required to issue the 1099-R because money left that IRA. They don't understand it was non-deductible. They don't understand it was to fund a Roth conversion. They just know, hey, money went into this IRA and then money left the IRA. Therefore, we have to kick out the 1099-R. They're just doing their job. Sometimes it will be coded in those boxes, and I've seen different custodians use like different terminology on their coding in those boxes. Like specifically when we switched from TD Ameritrade to Schwab, there was a little bit different coding languages. Again, though, Jeremiah, you're spot on. It's your job at the end of the day to either instruct your tax professional, or if you're self-preparing, make sure that you're saying this was a non-deductible IRA contribution, and this 1099-R is just showing that once it went into the traditional IRA, it then left to get moved into the Roth IRA.
Yeah, and again, I would say when you get those tax documents, if you're one of those individuals like me where you just get everything and you package it up and say, okay, here you go, CPA, you got everything you need. I keep an ongoing spreadsheet too, where just kind of how my mind works. I'm a spreadsheet guy. It's like spreadsheets give me peace. If everything's just organized in a spreadsheet and everything's there, I'm like, it's just like how it's meant to be. But just make a little note or put a sticky, or if you're like physically delivering it, put a sticky note on it. Just FYI, asterisk. This was a non-deductible or whatever terminology you want to use. So then it makes them stop and say, okay, what's this? So they accurately input that data into your tax return so you're not getting penalized or you're not booking double income. Because imagine that you did do this backdoor Roth contribution, meaning you funded it with money that was already taxed. If it's just money that's sitting in your checking account or savings account, you already paid federal taxes on it. You probably already paid state taxes on it. You probably already paid your payroll taxes on it. Like all those taxes are probably paid. So then you take that money and you put it in a non-deductible IRA, using air quotes here because that was your intention. And then if it's not booked accurately on your tax return, then you're going to have to pay income tax on that money that you already paid taxes on. It's like the most inefficient way.
Plus the 10% penalty for early distribution.
Maybe if you're under 59.5. Yeah. So again, it's just important to, when you're getting these documents, just look them over. And not to mention that I have run into cases, this is a rare bird, but those 1099s, especially like doing a Roth conversion or doing an IRA distribution, it was just wrong. The number was wrong. I ran into it this a couple years ago where for whatever reason the custodian, there was some weird error in the transactions where it doubled up. So essentially it did a double, it doubled the amount of the IRA distribution that went out. And it was a pretty sizable distribution. So when they were filing the taxes, like, wait, what is going on? I'm like, that is not, and then turns out we had to work with the custodian, get a corrected 1099. So it all worked out. But I guess the point being is this. Look at the documents, and this will helpful too, because if let's imagine you sold a highly appreciated stock last year, and that's going to cause a pretty sizable tax bogey, just making sure that it's top of mind for the CPA, so then it doesn't kind of throw them of like, wow, this is so much different than what it was last year. Just being a little bit more proactive on that, that would be my suggestion.
Yeah, Jeremiah, quick question. So my methodology of I get a tax document in the mail or it's emailed to me and I download it as PDF. My method of just like I got a certain desk drawer I just open and then I just drop my tax docs and close the drawer, that's not effective. You've got to have a spreadsheet.
No, you can.
Are you questioning my methods?
Do whatever works. I mean, everyone's got their own method. As long as this arrives at an accurate picture of your income. And here's the thing too, some tax docs are going to come sooner rather than later. If you have let's imagine you have a non-qualified brokerage account that is listed as a partnership. Like I just know this off the top of my head, Energy Transfer. It's ticker symbol ET. If you hold this in a non-IRA account, just in your brokerage account, and you're collecting dividends or you sold it at capital, like that's going to generate a K1. It's not going to be included on that custodian 1099. So that may delay. Like, point being, I think at this point, if you have these types of investments or you have these other moving parts, don't be in a rush to just get that tax return done, because ultimately you want it accurate. And it's much easier, in my opinion, to delay it a few weeks or maybe a month or so to make sure you have all the information to put in there versus trying to accelerate it. Then you get a random K1. Like, let's imagine you bought ET, Energy Transfer, last year because you're like, hey, I like just for whatever reason. And to be clear, I'm not advocating for anyone to go buy it, but
it's just an example of a limited partnership that kicks out a K1.
Illustrative purposes, though, let's imagine you did that last year because you wanted to buy it. You never owned it before, so you're not anticipating a K1, and then you're doing all your tax return. You stay on your normal timeline, and then you get that K1 like a month later because K1s usually come out pretty late,
right up to the deadline.
And then you're like, oh, wait a minute, what's this? Like, hey, tax preparer, I need you to amend my return because there was this rogue K1. So again, just understanding the logistics of how these tax forms go and making sure you look at them, make sure they're accurate, just so there's no surprises, and any movements that you made throughout the year are accurately translated onto your tax return. And again, taxes. Fan of being very efficient with these. And for those of you who could be a good problem to have, that you have a legacy rental property. Maybe it's a single family rental property that you've had for years. And maybe this thing's starting to be a little bit more time consuming. The return on hassle, as I like to say, and maybe the net return isn't there because it's getting older. You got to do more repairs. So that net cash flow is starting to dwindle down. But if you sell it, you might be running into a large taxable gain. Let's talk about solutions to how to effectively evaluate a good decision on this type of investment and things to take into consideration where it might be time to say, time to go, rip the tax Band-Aid off, or find ways to defer it. This is the Real Money Pros. We'll be right back.
Businesses today face a barrage of challenges. They hunt for top talent, the search for the right benefits package, and the ever-rising tide of healthcare rates. And putting together the right team to run your HR-related tasks can be expensive, let alone time-consuming. Enter Ataraxis PEO, your professional employer organization ready to tackle all your HR needs from payroll to benefits administration, payroll services, workers' compensation, and talent recruiting. They've got you covered. With Ataraxis, you gain access to a team of experts who handle the nitty-gritty of HR, freeing you up to focus on what you do best, growing your business and growing your revenue. Ataraxis takes the time to learn about your business, crafting personalized solutions to help you and your team succeed. So say goodbye to the stress of HR administration and hello to Ataraxis. Experience the power of a true business partner with Ataraxis PEO. Visit ataraxispeo.com. That's ATARAXISPEO.com. Ataraxis, elevating businesses for the benefit of all.
I know you've been waiting a little bit longer than normal.
Jen's manicure spot needs an extra pair of hands.
Who's at the front desk right now?
Someone who's handy with everything from nail files to spreadsheet files.
Deidre's not coming in today, but we have that whole bachelorette party.
Indeed can help her hire great people fast.
I need Indeed.
Indeed you do. Instant Match instantly connects you with quality candidates whose resumes on Indeed match your sponsored job description. Visit Indeed.com/credit and get $75 towards your first sponsored job. Terms and conditions apply.
As a financial advisor, I often see that many families I meet with end up paying way too much money in taxes. If a healthy family has an insurance plan with a low deductible but high annual premium, why wouldn't they look at a high deductible insurance plan instead? They could save on their premiums and put those saved dollars into a health savings account, also known as an HSA. It's the most powerful tax advantage account title available to us, so why not use it? Take advantage of pre-tax money that could be grown tax-free and then use tax-free for all of your qualified healthcare expenses. That's why you need Lively. Our favorite because it's simple, fast, and free. I use it, my colleagues use it, and I recommend it to all of my clients. Visit Lively right away. You can even roll over your existing HSA money into this new plan and start saving right away. I know you're going to love the entire experience. Visit livelyme.com/pro today. That's livelyme.com/PRO. Lively is a proud sponsor of the Real Money Pros.
Back to the Real Money Pros.
And we're back. This is the Real Money Pros. Again, phone lines are open. 979-59-MONEY. That is 979-596-6639. Not the most time, but if you call in quick, we could probably get your question on the air and get it answered. You can also send us an email, Jeremiah@therealmoneypros.com, Nick, N-I-C, @therealmoneypros.com. Again, visit therealmoneypros.com. Take our Better Buckets assessment. See how our bucket strategy can work for you. Give you a great foundation to understand why you're invested in what you're investing and what tangible financial targets that those investments are actually working towards. So again, visit therealmoneypros.com. Okay, rental properties. This is, Nick, you could probably agree with me on this, that a number of clients that we work with have owned or own a rental property in one way, shape, or form.
Yeah, absolutely. And I think I'm safe to speak for all of us here. We're fans of real estate in your portfolio. I mean, we've seen a lot of people benefit from getting into the rental portfolio business, and we've seen it pay off long term by having incredible sources of passive income. It supplements their retirement nicely. For many clients, it is their entire retirement. Like they're not even touching qualified accounts because they've got plenty of passive income coming in through their rental properties. So
tax benefits as well with the depreciation, if you got expenses, you can write out, meaning there's, not only from the cash flow standpoint of it, right? Like, again, I would say looking at a rental property, I look at this through an income lens, right? Like, meaning we're in this thing for income, but there's also those tax benefits that do come along with rental properties as well. So again, I agree with the sentiment. Stock market guys say rental properties are not a bad idea. Wow, imagine that.
Yeah. But so here's an interesting scenario. I just had a conversation this week with clients that they have a rental in particular that we've been evaluating every single year. Now, this rental is in another state. They use a property management company to help them get the right kind of people into the property, maintain the property, all of that, because it just creates a level of ease, again, since this property is about 7 hours away from them.
Well, yeah, I mean, it's like you got eyes on the property, number one, right, for maintenance, handling the billing collection, all that, like meaning hiring anyone you would need to replace the fence, do some plumbing work, I mean, whatever the case is.
Correct.
That property manager, they're in place to do that. Now, which I'm not to steal your thunder here, but what goes along with that is a cost.
Yes. So speaking of cost, here's one of the things that we keep evaluating it year over year. What is the current value of the property, and what are you able to collect in rent? Now, if the property was paid for, So far, they've been averaging about a 6 to 6.5% yield on that property, which I think we can both agree, Jeremiah. I would say, yeah, that's a more than adequate income yield on the value of this property. However, they have a mortgage on the property, so what they're actually netting on an annual basis, about $100 a month is what they're putting in their pocket for having this piece of real estate that they have to pay a property management company to oversee, that they have to budget for the repairs that are inevitable when one tenant moves out and another one moves in. The age of the property, they're anticipating a new roof within the next few years. They're looking at the positive cash flow of this property and saying, man, if we're going to maintain this property and keep on renting it, we're actually going to have to dig into our own pockets to come up with the cash for these major repairs that are upcoming. Maybe it's just time to sell it, to rip the tax Band-Aid off and sell it. Then the conversation also led to, and here's a couple upcoming expenses just on the personal side of life that we see within the next 1 to 2 years that we would like to be ready for. We have equity now in this property. We've got about we've gained about $100,000 in equity, but it's locked up right now. Maybe we just liquidate the property, free up that equity. And so we've been evaluating the tax ramifications on that. Understand this, you're only going to pay long-term capital gains taxes on the gains that you've made, not the full cash amount that you get out once you sell that property. So in this scenario, the numbers work really easy. They've got about $100,000 in gains. At their current income level, you even roll those gains, the full amount of gains, into their income, they're still going to be squarely in the 15% long-term capital gains tax bracket on that property if they sell, which means a tax bogey of $15,000. The state wherein this property is located does not tax long-term capital gains on real estate.
Interesting.
Yeah. So in order to get access to all of their equity, it's going to cost them, so they'll get access to about $300,000 in equity minus $15,000 in a federal long-term capital gains tax. They're going to pocket $285 and actually then have that as a resource to redeploy, some of it for ongoing income, some of it for upcoming personal expenses that they're planning for. And it just makes sense because they're not really netting much cash on a year-over-year basis anyway.
Well, in my opinion, that's the beauty of this zoomed out look of all these various options that you could take with this. It's like, it's not like it's either A or B. It's like we got a B, a C, and a D. Like, meaning we keep it and we know, hey, how things are, like what the trajectory is. But we also, based on that, we understand the liability of that. We understand that expenses pop up, and then we get a really pretty good projection estimation of what your net income is going to be. Dang, I don't like that. That doesn't look good. Yeah, no, I agree. So now let's look at what are the other options, right? Do we need to provide liquidity, like the tax ramifications? Okay, maybe we're looking at a scenario where that tax bogey actually has a significant impact to everything. Okay, what options do we have to potentially defer those taxes down the line? You have options in that regard too.
Right. So one thing to consider, and we will be talking about this as it leads up to, actually listing this property, is doing a 1031 exchange with the gains, doing a 1031 exchange into a Delaware statutory trust, which is just, think of it as a real estate portfolio that qualifies to meet the rules that the IRS has of doing a like for like exchange. Meaning if you own a piece of real estate and you want to sell it and you want to defer the taxes on those gains, then you can move those gains into a DST, for short, a Delaware Statutory Trust. It just satisfies the need to go like for like, and most DSTs are going to continue to pay you income on a monthly basis. There's a trade-off in this. You no longer have to deal with the management of the property, the management of the repairs, the management of the tenants. All of that is done for you. Your yield, meaning the income produced off of that, is going to be slightly lower. That's a trade-off, right? So again, let's go back to the scenario where if If this rental property was paid off, they've been getting about a 6 to 6.5% yield. You're going to have a hard time finding that on a solid DST, if I'm being honest. You should really set your sights for around maybe 4.5%, 5%. But that 1 to 1.5% decline for many, many people is worth it because it eliminates the headache of everything else associated with real estate. You're deferring taxes. You're still getting income off of it. And let's be honest, they take their $100,000 of gains, roll it into a DST. Let's say they only net a 4% rate of return. That's $4,000 positive cash flow over the course of the year when they've only been pocketing $1,200. So that's already a win right there. And DSTs operate just like an individual piece of property where if one of the spouses passes away,
step up in basis.
They get a step up in basis. If they both pass away, they're heirs. Get a step up in basis.
Now, one argument against the Delaware Statutory Trust, Nick, which is something that we need to take in consideration, is the liquidity. Generally, you're looking at a lockup of that money for about 7 to 10 years.
Correct.
Generally.
Correct.
Now, there's a way that you can mitigate that, though. When you do a 1031 exchange, you do not need to 1031 exchange everything, right? Now, the whole point of this is to defer the recognition of that taxable event. But obviously, if you sold it, you got to cover that whole tax bogey that we're talking about. But if you do a 1031 exchange and we want to keep some hold some liquidity back based on our tax projections and making sure like we're threading the needle, 100%, we can withhold some of those gains back. Yes, you have to pay taxes on that amount, but you're in control of how much, and you get that liquidity, which can help offset that lockup of the money. These are valid strategies, and we're here for you. This is The Real Money Pros. We'll be back next weekend.